Okay, good morning again, everyone. Happy Monday, and welcome to Saxo's weekly market outlook call. Today is May 22, 2023. My name is Charu Chanana. I'm a market strategist with Saxo Singapore, and I will be hosting this call today along with my colleague from Saxo's Hong Kong office, Redmond Wong. So like every week, we will talk about the key market trends that are top of mind for traders and investors, and that will hopefully help you uncover some of the interesting opportunities in the markets right now. And without any further delay, let's start this update with a quick discussion on what's really happening on the debt ceiling front. So we had a bit of relief earlier last week. There were hopes of a deal, but so far we haven't gotten anything. And my sense is that the talks will linger until the last minute, which is the ex-date of June 1, which is the expected last day when the US can fully pay its bills. And on Friday, we actually had obviously things going a little bit down south when there was a lot of finger pointing between the Democrats and the Republicans, each side obviously trying to get something from the deal. And at the same time, President Biden being in Japan for the G7 meetings. So I think that was one of the 10 situations that have again come out in this discussion. And looking at the current, VIX levels in the equity market, the equity volatility, it appears that the market doesn't really seem to think that there will be a US default. And of course, it is extremely unlikely we get to a stage of a default. But even if we don't, just the whole discussion that's going on, the weight is lingering, and both sides trying to get something out of this deal, does suggest that we can continue to get some more, volatility because of this event. I've again here on the slide listed at the bottom the scenarios that I shared last week on this call as well. But the key here is that the risk is going up as we approach the date, and the market has been quite complacent so far. So investors should perhaps be looking for some cover here, whether it comes from treasuries or from gold or from VIX itself. And just for reference, the 2011 debt ceiling drama, at that time the S&P was actually down 17%, and gold and bonds rose. So I think that is really important to consider. And there's another part of the debt ceiling conversation that is really necessary to bring your attention to is what happens after we really get a deal. So if we do get a compromise, the negotiations will likely result in more fiscal tightening as well, which will potentially help the Fed to achieve its goals on inflation. But what really happens is that all the policies that boosted personal income and corporate income over the past few years will likely be reversed. That means there will be a barrage of bond sales by the Treasury to meet its obligations because of that resolution that we get to. And that could really drain liquidity from the banking system and push up short term borrowing rates as well. And we're talking about huge levels here, something like $1 trillion of liquidity drain if we do get that debt ceiling deal eventually as well. So, such a drop, if we see in liquidity, that will obviously mean a massive strain on risk assets, particularly again equities and credit. So I think both ways, the approaching the X date and the volatility associated with that. But even if we do get a deal, what it means on liquidity thereafter are both pointing towards a bearish picture for equities, which again means that we should probably be looking at some downside protection there. Okay, moving along, let's see what's happening in the US on the economic data side. So that is still pretty much in Goldilocks, I would say. We had firm retail sales data last week. Jobless claims was also lower than 250K, so not really spelling any immediate trouble on the labor market side. Fed speakers remain pretty much mixed, I would say. Last week, we had some signals for the first time that some of the members were still open to a June rate hike, as against that coherent signals of a pause that we'd been getting so far up until last week. So that really made the June rate hike pricing for the Fed to rise up to about 40% last week. But now we're back at less than 20%. I think we're very close to 10% now. And that's because we had Powell speaking on Friday, and his inclination kind of remained towards a pause in June. He remained cautious of the lagged effects of tightening and as well as the banking stress, which, as we said earlier, earlier could also, of course, get worse if and when we get that debt ceiling deal because of the liquidity hole that deal can create. So I think a pretty mixed situation there on the economic front. But this week we get the Fed's preferred inflation measure, the PCE for April. It's out on Friday and likely to show that inflation, again, still remains elevated. The Bloomberg consensus is looking for unchanged numbers, 4.6% YOY and 0.3% month on month for the core PCE, which is still obviously significantly more than the Fed's 2% target. So I think that certainly still makes a case for more tightening. But as Powell indicated recently, I think the case for a June pause is evidently clear because they want to wait to see the effects of the tightening, and they want to get through that debt ceiling deal as well and kind of understand what kind of a pressure it creates on liquidity on the banking sector again. We also get the FOMC minutes on Wednesday from the May meeting, but again, we potentially would be looking to see if some of the members have an appetite still for a rate hike in June. But like I said, after Powell's comments last week, any comments will have to be significantly more hawkish to really move the needle in terms of market pricing. The other key story I absolutely wanted to talk about today is the optimism in Japan. So we had Japan's equity markets in the Topix index reaching a fresh 33-year high last week. A lot of tailwinds are really lining up for Japan. Inflation's coming back. Corporate governance reforms are gaining a lot of traction there. And Berkshire Hathaway also recently increased the stake in Japan and is supposedly looking also for more opportunities there. I've also noted some of the latest Bloomberg headlines here on the right side at the top. But importantly, Japan is becoming the latest to benefit from those US-China tensions as well, with some of the chip makers looking for an alternative manufacturing destination. So we had Micron last week announcing an investment in Japan, and it is expected that other chip makers like TSMC, Samsung, Intel could also follow the move. So I did have a lot of questions last week that after such hefty gains, with topics now in overbought territory on a technical basis, do you think the rally can still continue? So certainly, I think there can be some pullback as technically gains have stretched far too high, but we're coming after years of underperformance in the Japanese equities and relative valuation. If you compare them to US equities, they're still pretty cheap. So, looking at the fundamentals, it does look like we could see this outperformance getting stretched further. But of course, after such gains, you would expect some of the market players to kind of take some profits as well. And just on staying on Japan, we also had a strong Q1 GDP print last week. So I think that obviously again increased the case for this outperformance. And this week, we will be focusing on Tokyo CPI release for May, which is again out on Friday. And it will again likely confirm that inflationary pressures remain firm in Japan as well. But still, for the Bank of Japan, that will potentially not be enough as they are really waiting for firmer signs of wage inflation. So I think not a lot of takeaway potentially from that Tokyo CPI print, but just that it continues to keep that pressure on the Bank of Japan to continue to, kind of look for opportunities to reduce the amount of easing that's there in the system right now. Just summing up the key market moves from last week here on the slide now. As you can see, there's a clear outperformance of the Japanese index in the equity space. In fact, Germany's DAX index also reached a new record high. That's not shown here, but clearly a lot of stories around in Europe and in Asia, especially when US equities are facing these debt ceiling risks, liquidity risks, and eventually risks of a potential, growth slowdown or recession later this year as well. So very clear case, I would say, of diversification to outside the US as well as, even beyond equities, other asset classes as well. That's really, I think, important to consider. In the commodity space, I think a lot of volatility going on there, especially a lot of drama in the oil market with, US calling for refilling of its strategic reserves to IEA and OPEC still guiding for a strong demand in the second half of the year. But macro factors remaining more key for oil at the moment, I would say. So what happens on, in terms of the Fed meetings in June and beyond that as well, is certainly where the oil traders are focused on right now. Copper and gold as well, stuck in recent ranges. We had gold threatening some key support levels last week after that hawkish rhetoric came out of the Fed members. But again, after Powell spoke on Friday, and then again with debt ceiling concerns back on the radar as well, we have seen gold making some recovery from those lows, and nothing yet, I would say, really to question the bullish outlook that we've shared on this call several times on copper and gold. On FX, I would say the US dollar is being somewhat mixed last week, at least. It was pressured lower because of the gains in Kiwi. And, this week again will be key for Kiwi because we have the RBNZ meeting on Wednesday, I believe. And they are expected to hike rates again. So I think whether the Kiwi strength is maintained or not, will certainly depend on what kind of a guidance we get from RBNZ going ahead, because certainly the inflation expectations that we saw for the second quarter have come significantly lower from the first quarter inflation expectations. So I think really important to see how the RBNZ kind of goes through that, as well as the budget kind of still pushing for growth higher. So I think they really have to balance the two sides very delicately there. Then Japanese yen has been particularly weak because of the rise in yields, and short-term outlook, I would say, remains pretty bearish with the debt ceiling risks again, resulting in further gains in yields, if at all. Unless, of course, risk sentiment completely breaks down, takes a sudden slide, and that could bring some respite to the Japanese yen. I think I will stop here and pass it to Redmond for all the important discussions on tech stocks and China and more.
Hi, morning everyone. Yes, and I mean, it's the U.S. Equity market has really been led by the mega cap tech stock since March 10. The reason I said March 10 is because it's March 10 is the day that Silicon Valley Bank fell, and then the market collapsed. But after that, the market we rallying, and but if you look at the chart here, you can see, I mean, it's mainly driven by Nvidia, Meta Platform, and Amazon, Alphabet, Apple, Microsoft. And you can see the Nasdaq 100 is up nearly 17%, but S&P up only 8.5. And look at the Russell 2000, the divergence is really huge and haven't really seen that for a long time. And the Russell 2000 is only basically flat during this period of time. And yes, I mean, it's the earnings from the mega cap has been strong, earnings strong, and also balance sheet, they were also strong. And also there's a lot of expectation on the AI development, and we know it's the VDS, really, even though trading very expensive, but you have a lot of promising, at least is investors look at that way, is the prospects of benefiting from the large demand for computing power because the AI, the development, the AI. So Nvidia is really one of the best performing stock leading, and also Microsoft and also Alphabet. Yeah, the other day, our head of equity strategies, Peter Gani, has issued an article is saying basically is discussing the case that is Alphabet actually has a good potential in AI, and while everybody looking at Microsoft, but we think that is Alphabet probably will be actually is the later on will catch up and lead. And so it's really is, but if you look at over the last few weeks, I mean, despite it's a very strong rally on those mega cap. If you just focus on it in May, S&P actually is really stuck in a very low range. It's only 4% range. I think investors are struggling to make sense of the bull case and the bear case in for the U.S. stock market. And when on the bullish side, and is that the Fed is near a pause. If they will pause in June, or they are not too far away. And then is the U.S. growth, and look at the recent data, and in fact, U.S. growth has the recession fear, which dominates, especially in March and early April. Now the recession fear has actually subside. Came down a bit, is given all the the strong retail sales number and some other high frequency number, and showing the economy is still doing uh, okay. I mean, has slow but not, and also some of those fear about credit contraction for because of the fiasco in the regional banking, and has not materialized yet. And we have been seeing bank tightening lending standard, but at the same time, is not as much as people fear. And the small business in some sort of way actually did not seems that they are facing a lot of difficulties in getting financing. So that is really the and the U.S. market cap, and it's still looking good at the prospect. So the bull case, and when the investor look at it, is really the Fed is close to a pause. U.S. growth is not running into recession, and the U.S. market cap is very promising, and so that is really what the bulls in the market hanging on these other factors. But at the same time, you have also a lot of concern from the more conservative and more prudent, or some of the investors, they take a more bearish look in the market. I mean, folks, and I mean, inflation has been coming down, but it's not sufficiently. It's not yet near the 2% target, and so the Fed may or may not have done. And then the market is expensive, and especially when we are leading by the market cap. I mean, they are not cheap if even though the earnings has been doing very well. And also the breadth of the rally is really focusing on those six seven stocks, and so it's very narrow, the rally. And then is the Charu mentioned about the post, even we have the debt ceiling resolution, and in early June, or every time. And but after that is not only the Treasury need to issue a lot, about a trillion card debt, and mainly in T-bills basically, and then is but they, at the same time, where towards the debt ceiling, and the Treasury Department will be running down the cash balance at the Fed to below kind of 30 billion or something, and then that normally they need to have 550 or 600 billion cash balance at the Fed. So they need to replenish those. So they will take those some of those money from the new issuance, new borrowing will be take it back to the Fed, and push up the cash balance there. That is the liquidity drinking from the banking system in back to the Federal Reserve. So that is at the same time you have the Federal Reserve doing QT, 95 billion a month. So and then you need to and then the Treasury Department over the next 2 months, they will bring the cash balance at the Fed back to close to 600 billion. So they are drinking something like 550 billion there. So there's a lot of liquidity drainage, and also some when the Treasury is selling a lot of T-bills, and then those money, so that will be so that is also giving some pressure. And so that is one, and then this is one of the bearish argument, and also the last but not least, and for the bear, and of course they were concerned that the aftershock from the regional banking crisis has not yet really completed yet still. So there's still a lot of risk there, and so that's why the market actually locked in this kind of circling. In fact, if you look at the most recent 1 or 2 weeks, the performance is really tech, and then the defensive sector, and then actually the traditional cyclical sector in the U.S. market, like I have not been doing that well. I mean, this actually, so people are either doing the more defensive trade, and at the same time and try to chase the best performer in the market. That's the mega cap. So those in between is kind of under some selling pressure. So and the overall market is a lot in the low range. So I think it's for investors, and what to make out of it. I mean, is of course depends on your view, but at the same time here at Saxo we think that maybe not a bad idea to buy some protection, and while the volatility is still not expensive, and so it's buying some put and to protect some of your profit, especially in the mega cap stock. That may not be an idea, and then you can net the profit one on the upside. And and then it's back to this part of the world in Hong Kong and China. Also, is that since over this period of time is you see the basically is Hang Seng and also the CSI 300 lock in kind of very low range, 5%, 5.5%. Market has investors lost some confidence, and mainly because the recent economic data is showing that April Chinese economy has decelerated a bit, and not as strong as people hope for. And especially the activity data we saw last week. So we had the industrial production, even though year on year it was increased, but if you look at the sequentially after seasonal adjustment, actually it's a decline from March. And then if you look at retail sales, yes, it's up 18% year on year, but if you look at the sequential, i.e. comparing with March, and then you also take into consideration of the seasonal adjustment, and it's pretty much flat. But the bright spot there is some of those the services is still consumption on services still doing quite strongly, and also infrastructure spending, and also e-commerce has been doing also was also doing pretty good in April in those April data we saw last week. So from the earnings side, you see look at the JD.com uh, and Baidu has been was pretty good, but the disappointment was really Alibaba, because it's the domestic e-commerce revenue came down, and also cloud revenue also not as good. So there's some kind of mixed bag, and the market investors still very cautious about Chinese stock, and so some of those will be will focus on the state-owned SOE because of the policy tailwind, and and then is uh, and then is and then is the other thing is and then yeah, I mean, and then in the and then yeah, I mean, and then it's on the growth side, and investors has a bit of concern about the China internet stock. So the mark as Saxo here, we think that yes, I mean the growth, the recovery was weaker than expected, but a little bit slow. But we think that is still ongoing, and the market is, I think, maybe just was a little bit ahead of themselves earlier, and being too bullish initially at the beginning of the year. Now the position wise has been much lightened, and that will be actually a setup with possibility of for the market to cry a war of the war of worry, and to rebound lately. So this week in terms of earnings, and the important will be we will have a Nvidia in the US. I think the most
Redmond, I
important.
think we need to just move our slides. I can't see the earnings slide, perhaps.
Yeah. Can you see here?
No, it's still on the US equities slide.
Really? Yeah.
Okay, anyway, go ahead. It's fine.
Yeah. Okay. Um. Okay. Yeah. We can. I just. The. Yeah, I mean, it's the most important thing is in the US is Nvidia, and because it's really the market leader of this rally, and so that will be coming out on Wednesday, and then the others earnings will be giving us some ideas about the US consumer, will be Costco and Dollar Tree and Lowe's, and in China and Hong Kong, and the key thing will be to watch will be Meituan on Thursday, and also we have Kuaishou and on Monday today, and also of Xiaomi on Wednesday. But the key thing will be on Meituan in on Thursday. And I think, yeah, I think that is all from China and US. And Charu, you want to talk a little bit about uh, the economic numbers and so on?
Yeah, I think we covered quite a bit there. I mean,
Hmm.
for the US front, we have obviously the PCE and the FOMC minutes, and we have Japan's Tokyo CPI. I think we've already overrun quite a bit, so I'm probably not going to talk a lot more here. But I think, of course, do feel free to read through our articles. We will be putting out a note on Saxo Spotlight today, which covers what to watch in the week ahead. So that will cover the economic calendar and the earnings calendar a lot more in detail there. But that's it from us today. We hope you enjoyed this discussion, and thank you for attending. Stay safe and have a good day, good week, everyone. Bye.
Thank you. Bye bye.